Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called No European Energy Crisis, No Problem. Not so fast, says the economy. In 2022, the energy crisis in Europe created significant pessimism. However, a record warm winter averted a further crisis, and European stocks have rallied significantly higher. But the absence of a crisis is not the same as a recovery, and we'll explore the question of whether European stocks are overvalued. On the agenda, we'll discuss energy in Europe. We'll look at the euro, fundamentals, and then valuations. Then, as always, at the end, we'll explore the investment implications. Today, as always, I want to welcome the co-founder and chief investment officer at Nucleus Wealth, Damien Klassen. Welcome.
Hey, Sam. How you going?
Good, thanks. And we're also joined by David Llewellyn-Smith, who's Nucleus Wealth's chief strategist and co-founder also. Dave, welcome.
G'day, Sam.
Hey, Dave. My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. For those listeners that don't know, Nucleus Wealth is an Australian active and passive investment manager. We're a global macro investment house and use the insights shared in this podcast to construct and manage our active portfolios. We're also the first to offer passive direct indexing in Australia, which has been labelled ETFs 2.0. The benefit of this is you own all the stocks in the index via a managed account rather than just one ETF security, and this allows you to customize your chosen index. We have around 50 different ethical, sector, and asset class screens, along with 8 specific tilts or additions you can add to your portfolio. Therefore, you can customize your index or any of our active portfolios. Just a reminder, this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with myself. If you enjoy our content and want us to continue to make more, please subscribe to our YouTube channel and click the bell below to make sure you don't miss out. We are live every Thursday at 12:30 Sydney, Melbourne time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind during the show and we'll do our best to answer them live. You can also follow us on your preferred podcast platform as our show is available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon and you can view these at nucleuswealth.com/webinars. So Damo, now I've got those formalities out of the way, I'll pass it over to you to lead us away.
Yeah, sure. Thanks, Sam. Bit of a pretty decent rally in terms of European stocks in the last couple of months, and we've had a big change in terms of the fundamentals on the back of lower energy prices, and we just wanted to sort of revisit the story because it's and I guess at a simple level it sounds all good, but there's a lot more going on under the surface. So we sort of wanted to dig through that in a lot more detail and sort of have a look at what's there, what's changed, what the pricing looks like, and therefore what should Europe make of what proportion of your portfolio should be having in Europe, given all the different outlooks. So I thought we'd start with the energy sector. And what I might do is I'll run quickly through some of the changes we've seen in terms of the gas that's coming through, because that's obviously where the biggest issue's been. And so I've got a chart up which is just showing the total energy brought in over the last few years, sort of month by month. You can see 2021, 2020, 2022 are the pink and the red lines, and then the dotted line shows like the last 5-year range, and then we've got sort of the 2023. So we can see that at the end of 2022, it was like basically as low as it's been any time for the last 5 years, and it's still relatively weak. Slightly better than the lows, but it's certainly relatively weak in terms of the amount of gas that's been flowing into Europe. That's the total gas. If you just dig in just on the Russian gas, you can sort of see it's down by 80-something percent, 85% or something like that on prior levels. So from the start of the year where there was a fair bit of Russian gas flow, but still quite low. relative to the prior 5 years, then dropped through the rest of the year, and the blue line sort of showing 2023, where it's 85% down on its average over the last 5 years in terms of the flows coming through. So the good news, though, has been, given it's been a very warm winter, the storage is actually as full as it's been at any time over the last 5 years. So this sort of the third chart is showing what the storage is, and sort of we're a couple of weeks in to 2023, obviously, and that blue line's right at the top of where it's been. So very, very full. There's a lot more supply coming on in terms of the US. Not as much over the next year. There's a bit coming on over the next year, but certainly into the following year, there's plenty more coming on. Plus, Europe's going hell for leather in terms of renewables, and actually not only that, I think part of the problem has been they've actually bought a lot more, say, solar panels and wind, and just haven't actually been able to install it all yet. So the delays, so it hasn't been as much sort of sourcing it, and it's probably been more so in terms of actually getting the installations up and running. But that's sort of coming again over this year. So so that's all going well. We spoke a little bit about the LNG in particular from the US, and I've got a chart just sort of showing that month by month over the last 2 or 3 years, the LNG, you can see the blue line at the bottom of that is from the US, and that's significantly increased to offset the losses we've seen from Russia. So net effect of all that is it looks as if the worst of it is behind in terms of the energy. Having said that, if we had a very cold winter next winter, you'd still probably see some decent spikes in terms of prices. But I think that the real danger part has passed, and real danger in terms of supply from Russia, and it looks as if they're sort of on the way there. Or having said that, prices are still a little bit high. So I might hand over to you, Dave, to maybe talk about prices.
Sure. So the Dutch TTF, can you guys hear me?
Yep.
Yes.
The Dutch TTF is just below $50, I think now, 50 euro, I should say. And historical range is, sort of somewhere around 10 or a bit higher. So they're still paying, through the nose for their gas in historical terms. However, it has come down a lot from, what were the peaks? Didn't last all that long, but, up around sort of 250 euros. So, I mean, it's dropped heaps, but if you look beyond the Ukraine war, it's still quite expensive. I expect those prices to keep falling with more relief. Not just gas either, like gas and coal are both, really getting an absolute thrashing, and there's more supply coming for China. So, there should therefore be more availability for Europe as well. So, as Damo says, barring a cold winter next year, the European energy crisis, has settled down very quickly, much more quickly than most people thought, and will continue to do so, basically. So I would expect prices to continue to bleed lower, even though we're now into the seasonal strong period. And because the gas inventories are so high, Europe, will be able to refill its tanks really probably by the middle of the year, sort of July, August, which would be 2 or 3 months earlier than normal. And so there'll be a lot less pressure going into winter for 2 or 3 months, which is part of a strong sort of buying period, and normally won't be there. That demand won't be there. And so, therefore, I do think that there's more downside still for these European energy prices. And then, you know, of course, we could have another shock if we had a nasty winter, or, of course, some other geopolitical tail risk presented itself with Vladimir Putin doing something new. But that's not our base case. We think that's sort of settled down into something of a grind, the war, and something of a stalemate. So the news is, well, should continue to be good on the energy front for Europe, and therefore, strangely enough, for Australia, because as we know, so much of our own gas exports actually cost us money rather than making us money. So the energy story is good for Europe, and you know, they've had almost fantastically high inflation on the back of the energy shock, as well as other supply side problems. But that should continue to improve, as I said, you know, barring other accidents. Where we sort of kind of see an offset developing for this is on two fronts. One is, you know, there was a lot of fiscal stimulus that came in to help to support businesses and especially households through the energy shock. So a lot of, you know, the crazy price rises that we saw never actually hit the real economy because there were fiscal offsets, you know, subsidizing bills, not in their entirety, certainly. And definitely in industry, you know, there was real demand destruction and efforts to, you know, austerity efforts to actually shut down certain parts of industry, metals processing, for instance, that use a lot of energy. And so that refers back to Damien's chart earlier in the presentation, where energy inputs are much lower than normal. So some of that will restart. That's obviously going to be a growth positive. But that fiscal support is going to come out. And so what has been a very, very potent fiscal impulse in Europe, that is rising fiscal spending in net terms, is now getting smaller and smaller, and by around Q3 it'll actually turn negative. So that fiscal tailwind is diminishing, you know, right along with the energy shock. So it's not a simple case of simple tailwind. It's actually a, you know, tailwind meeting a headwind, and you've got to figure out, you know, where it nets out. More importantly than that, the whole energy shock phenomenon in Europe triggered such high inflation that it, you know, put a rocket under the European Central Bank. And so we're moving to some of our other charts here. And so the ECB has moved, you know, pretty quickly and is still catching up to the Fed, doing 50 basis points per meeting hikes. At its last meeting, it started to ease back on its rhetoric and started talking about maybe doing 25s, you know, once again, I guess, parroting the Fed. However, you know, how long that lasts really depends on the progress with inflation, which is, you know, also sticky in Europe as well as the US, you know, with some relatively strong wage inflation in some of the countries. So, you know, the ECB has basically been tightening pretty hard on what is a pretty weak economy, you know, an economy that's barely growing as it undergoes these various energy and supply side shocks. And so there's a tail on that now, that tightening that is already clear in the credit impulses, bank lending standards, and is going to have, sorry? Bankruptcies are up really sharply more recently. And so this is going to be a pretty serious headwind for European growth. So I've put up, you know, Deutsche Bank's modeling of the impact of tightening to date, and it is quite substantial. They're talking, you know, 2% of GDP gone as a result. And you know, the best case scenarios that I've can see for European growth, where bulls are riding it up at the moment is kind of 1% in Germany, perhaps on the energy relief, but I don't think that they're taking full account of this ECB headwind, which is really going to intensify as the year goes on. Deutsche's view is that it really kind of peaks at the end of this year and into next, which seems reasonable to me. It started a little later than the Fed. So the cycles are not fully aligned, but you can see it already, not just in kind of credit impulse terms or broad money measures, monetary measures and things. They're all way down. And I've got another credit on that. Another chart here where you can see that, but it's actually impacting, right at the coalface with rising bank lending standards already in Europe. So if you keep swinging through the charts, you'll see that credit standards in Europe are already, pushing up towards what they were during the European debt crisis, for instance, which did ultimately cause, a kind of minor recession in Europe. So, we're already seeing, and this is across, the various segments. So households, consumers, and businesses are all confronting both higher rates and more difficult lending standards already. And the ECB is not done. We've got another 50 hike coming in the next meet. And, pick a number, but multiple 25s after that. And at the moment, there may be even some risk of them turning more hawkish. And the reason for that is that, if we continue through our chart presentation here, is that, the recent soft data, sort of leading soft data, PMIs and such in Europe have bounced. If you can look at it country by country, but if you look at the overall Eurozone and its composite PMI, you are starting to get some growth. It's moved above 50 and what have you. And I don't think...
Yeah. So I've actually split these ones to Dave, because it's a thing with the manufacturing still weak in terms of the PMIs. So that's a smaller part of the economy than the services part.
That's right.
Well, services have turned up, and that's the part which is driving the overall purchasing manager index. So manufacturing weak and exports are down, and all these other factors in that manufacturing sector all look quite poor. On the flip side, the services is looking strong, and
stronger, not strong. So, there is creeping services inflation in Europe, which is why what we're seeing right now in the US, for instance, is a shift away from market hopes that we were going to see a swift squashing of inflation and then rate cuts and then a rebound into a new cycle. And that, ironically, that narrative drove markets up so much that I think it started to actually affect the real economy. And so the US is reaccelerating, and the Fed and markets are now being forced to reprice their terminal interest rates higher. And I think there's a definite risk of this for the ECB in the short term.
The other thing with some of these services PMIs, like some of this could well be China reopening as well, and part of the whole,
it could be tourism. Yeah, absolutely, it'd be part of that. And China, I was going to come to. That's another very big component of this story. China, the China reopening, we might as well tackle now, is kind of actually triggered at least part of the big European rally that we've seen over the last 3 months. And there is good reason for that. European exports to China are material. They're about twice the size, I think, of US. And they tend to be more, kind of highly priced, elaborately transformed manufacturers, things like cars in particular. And so the China reopening and demand, will definitely benefit Europe. Now, moreover, the composition of that rebound in China, we think, will be very consumer-led. So that is actually better for Europe too. If it's discretionary goods in China that really fly, rather than, the typical stimulus areas such as construction, etc., then Europe does stand to benefit. So that is another good story for Europe. So it's not all bad at all. It's a very mixed story with headwinds and tailwinds. But again, inflation is still very high, still quite sticky, especially in services. And so if we see, this rebound, then we're very, very quickly going to start to get a repricing of the ECB terminal rate as well. And because we've got credit already tightening and on the slide, I think that's the ultimate determining factor here for Europe as an asset class, if you like, over the next 6 to 12 months, is that the ECB is the one to watch most.
Actually, before we go to the next one, it's probably worth just jumping on that bankruptcies chart as well, just to show that for viewers. So, on the bankruptcy side, so basically, we saw similar thing to happen in Europe to what's happened in most economies, where the rules changed around the pandemic so that it prevented bankruptcies from happening. And so the yellow line there is declarations of bankruptcies. And so it came from pretty high levels in 2015 because of the slowdown. So you can sort of see it hovered around about 90 for most of the late 2020s or 2010s, and then fell quite significantly into COVID. And then we saw this bounce back in the most recent quarters. So third quarter was basically back to where it had been pre-pandemic. And then we've just seen this massive explosion in bankruptcies in Q4, well above prior levels, and back to if this is just a catch up as a short term, a couple of bankruptcies coming through that probably should have gone bankrupt in the last couple of years, but it just all got delayed. Then there's not that much of a concern. But if this is a genuine, rates are higher. We're getting weaker demand, and all these companies are starting to go broke now. Then that's a much bigger issue, and seems like the right interpretation. But I guess time will tell.
Yeah. So we've got a slide here on the euro as well, just to show you that there has been big sort of resurgent interest in Europe. It's run very strongly, but is currently correcting again around this shift in the narrative in the US in particular, but which is starting to percolate out everywhere, including Australia, I suspect, where it's rates higher for longer because rebounding economies that haven't expunged the sticky inflation yet are going to force central banks higher and give us higher terminal interest rates. And so the euro has started to pull back on that narrative that's being led by the US, because we've had a stronger US dollar and the Fed turning more hawkish, at least in rhetorical terms. And so I'd expect that to pressure Europe for, until the market is sort of satisfied, I guess, that financial conditions have once again tightened enough in the US that they can contemplate the Fed again sort of easing up. Where that is anybody's guess. Yields have lifted a lot. Stocks have not fallen a lot yet. So the tightening may come from falling stocks. But I suspect it's going to happen relatively quickly. And we may do this again. Like at that point, markets may rally again and decide that's enough and inflation will be low enough, the Fed's done enough, and then have to go through it again where it wasn't enough, inflation was too sticky, etc., etc. So I'm not saying, I can't say for sure that the euro is off on a raging bull market here yet. But what I will say is that when we do reach the terminal rate in the US, and the US has done enough in terms of, crushing inflation, and the Fed can stop and ultimately cut, whenever that may be, then the euro is undervalued and very well positioned to rally. And that actually is made even more attractive by the fact that European stocks are, a lot cheaper than the US even after the rally. So I would, once we sort of reach, that pivot when inflation is sufficiently defeated, then Europe looks quite attractive for the ongoing cycle. So don't get us wrong. We're not European bashing here at all. We don't see Europe as in huge trouble particularly, but the issue is right now with the ECB tightening very fast, then it's like it's sort of out of the frying pan and into the fire for the time being, and if we do get, I think we're sort of, Europe is rather overbought and we're due for a good correction, and if we can see that transpire, then for the coming cycle, Europe looks like a pretty good buy.
The other thing to note is that there's sort of two big effects going through in terms of corporates in the US, in Europe, and we think that this sort of weak demand is one of them, and that's sort of putting pressures down. You've got a fundamental increase in energy prices and companies considering whether they do move some of the more energy intensive processes out of Europe and into different countries, and so there is this fundamental weakness that sort of we think is a downtrend in terms of the signal. And then you've got this short-term factor though, which is that energy prices, they went up 10 times and now they've come back so that they're only up 3 or 4 times, but they're still better than what they were. And so that's sort of like this positive impulse that we've got over this sort of negative longer term trend. And so I guess where I'm getting to is I think there's sort of like some positive, some very short term positive vibes that are coming through, where it's for Europe, where it's things are better than sort of dire, but they're still pretty bad. And so it's a matter of trying to weighing up where the right crossover is in terms of that, and acknowledging that the energy prices, as you said, are still 2 or 3 times higher than what they used to be, and while we think that'll come back over time, we are still talking a number of years of higher energy prices in Europe, and so at the margin, people will do things in other countries rather than Europe, into energy intensive projects in other countries.
So do you want to go through your valuation charts, Damien?
Yeah. So jumping to valuation. So I've separated out banks and resources because so European banks are cheap relative to the world, but they're also quite a large part of Europe, and they've been earning lower returns than what we've seen elsewhere, and so they do distort some of the figures a bit. But so European banks are relatively cheap relative to the world, but I did want to separate out, and the other thing is they've got Europe's got some quite big energy companies in there, and that's sort of and they look quite cheap as well relative to other resources, but I did want to separate out and sort of dig in on the industrials, because that's the ones where we don't see as much of a distortion in terms of these numbers. So if you look at sort of the absolute values of it, it's a little bit more expensive than average. So 14.6, slightly above its longer term averages. It's it's not too bad relative to what we're seeing elsewhere. Do you want to pay above average valuations for stocks? As you're going into a relatively weak period, well, probably not. But the next chart's probably more telling in that if you compare European stocks with world stocks, so Europe X banks and resources versus world stocks X and banks and resources, now's where you see that actually Europe still looks really cheap. It's gone from looking really, really cheap over the last couple of months to back to sort of at the 10th percentile of where it's been. So still very, so I guess the bigger picture is you're paying up for slightly above average in Europe, but actually you're paying well above average in the US for stocks at the moment. So that's one side of it, and then the other part though is keeping in mind that within these, the other thing that Europe's quite big in is automobiles, and they are looking quite cheap at the moment still. And part of the reason for that, though, is because nobody really knows exactly what's going to happen with them. So what's happened is, say they haven't been able to sell as many cars as what they'd want to because of supply chain issues, but the demand's been there for cars. And so what that means is they've put through a lot of good sized price rises. And so, it might be that, for somebody who's selling, say, 1 million cars a year, but they can only produce 800,000 cars a year, but they've still got lots of demand. So what do? Well, they jack their prices up. They've only got 800,000 cars. They literally can't make any more. So they add more to the price to bring the demand back to meet the price. And so that means they've made these great margins. Now, the car manufacturers are all talking about being a lot more disciplined going forward, not just adding more supply for the supply's sake and blah, 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 blah. And, this and why, and trying to explain why they're going to keep making these great margins for a lot longer. The issue is, it doesn't take many, it only takes one or two sort of big players who decide, no, they are going to go for volume, and they're going to go back, and if nobody else wants to produce, if you're producing, you used to produce 100, sorry, if you've got demand for 1 million cars, but you're only producing 800,000, you're jacking your prices up. Well, I'll jump in and I'll take that extra 200,000 and I'll sell my cars, 10% cheaper and pick that up margin up. And at that point, they all have to start competing again and pushing their prices back down, or just face the loss of market share. And so, so my take would be, if it was an oligopoly of 2 or 3 companies and they're all pretty disciplined and all that type of stuff, then maybe that'd be right. They could keep these high prices. The reality is, it is a very competitive market. There's, China's busily trying to break into the market. You've got some quite aggressive brands in Korea, and then you've got Japanese car makers, you've got US car makers, and you've got European car makers. It's quite a broad market. I think that to expect that not one of them decides to break and go for volume, I think would be a mistake. So so there's this element of saying, well, if you strip that out of the valuation, let's look at this whole thing ex car makers. Europe looks a little bit closer to average. It's still cheap. It's just closer to average if you strip out the car makers and assume that these car makers are on very low price to earnings multiples, but that's justified because they will lose a lot of their margins as the volumes all come back. So long way of saying it probably doesn't look as good as it does on this chart, but it still looks relatively good in terms of Europe. Does look cheap. It is a question of outlook though, and whether there's fundamentals company by company. I think I'd be quite careful about what I'm buying. And particularly energy intensive companies in Europe, I would be I'd want to be buying them very cheap relative to what I can see, because of the concerns over pricing.
Excellent. Okay, so now we'll go to our viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, does the pricing match the outlook in Europe? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. We have had a question come through from Jude. So Jude's asking, what are the pros and cons to dollar cost averaging into your active portfolios? So Damo, do you want to take this one, or do you want me to take it?
Sure, you can go, Sam.
Okay, cool. So essentially, you've got 2 options to get in the market. So you've got lump sum investing, where you put all your capital into the market at once, or you've got dollar cost averaging, where you put your capital into the market over a set period of time. So a simple example, let's say you've got $60,000. You think the market's going to bottom over somewhere in the next 6 months, but you're not exactly sure when, because it is quite difficult to pick that exact bottom. So what you'd do is you'd put $10,000 in per month, every month for the next 6 months, and then get your capital working into the market. So the pros for dollar cost averaging is it really takes out a lot of the psychological sort of biases and issues that come with investing. For example, if you often, when people put all their money in at once, they're wondering, have I got the bottom? Is this the right time? Is the market going to fall further? Those types of things. Whereas with the dollar cost averaging, you know that you're stacking probability in your favor, that you're going to get around about the market bottom. And I believe, I think if you've got long-term horizons, long-term investment horizons, you're stacking the odds in your favor that you're making a good investment decision for those long-term returns. And 5-10 years down the track, you would expect markets to be higher, and you've likely made a very good decision. The downsides of dollar cost averaging is Vanguard's actually done quite a bit of research around this between lump sum investing and dollar cost averaging. And what they've actually found is about 2/3 of the time you're better off lump sum investing, so you get higher returns, and about 1/3 of the time you're better off with dollar cost averaging. But yeah, like I mentioned, it is easier to handle from a psychological perspective with the dollar cost averaging. And the other thing is with the dollar cost averaging, let's say you put 10,000 in this month, 10,000 next month, and then the market goes significantly south. Well, that actually gives you an opportunity to put the rest of the capital in and get a better entry price. So yeah, it really depends on what type of investor you are. But those are sort of the main pros and cons that I can think of. Damo or Dave, have you got anything else to add on that?
Nope, I think we're good to go to the investment outlook.
Okay, over to you.
Yes, so look, I think that we've got some things up on the slide, just some of our thoughts we've sort of been talking about over the last few weeks, just in terms of positioning. I guess I'd like to sort of pull this back to Europe in general, and it is facing this whole, a lot about trying to pick the right stocks within Europe. For us, it's we have been slightly overweight Europe and a little bit underweight the US, and we've been trying to find the value stocks within that. So that's sort of been a positive from that perspective. Right now, given the market's rallied back, and we're underweight equities generally, I guess we're sort of looking for. We quite like Europe coming into the recovery, I guess is what it is. So it's probably one of the parts where we're trying to keep our powder dry, so to speak, and really looking for defensiveness still at this moment, and Europe's got a little bit of that, but we're really not looking for the extra growth we think you will get sort of coming into the new cycle. And so I guess the answer for me on Europe is, look, it's cheap. It's facing some significant headwinds, particularly in some sectors. It need to be quite selective about what we're buying, but we want to buy some more, but unfortunately the answer is not quite yet. Dave, I don't know if you've got anything else you want to add.
No, I mean, I guess all I would add is I'd reiterate again, I don't think that either the Fed or the ECB is done, and we're talking quite weak economies here, that may have had had something of a revived pulse over the last few months, but the inflation stickiness problem is very real, and so we may well convulse through one or two more bear market rallies before we're actually at the point where terminal rates are set and markets can really start thinking about a new cycle. So I guess I would say I'm expecting ongoing volatility, and that to include Europe.
Excellent. Okay, thanks for that, guys. So Damo, I do have a question. So at the moment, Europe, they seem to be fast tracking this transition into renewables. And question is, if you'd like to just let some of the listeners know how current clients of Nucleus Wealth are taking advantage of this, or maybe excluding stocks or including stocks, to take advantage of the screens or the tilts.
Yeah, certainly. So you can invest both in passive funds, so just picking stocks broader indexes of stocks, or you can go with our active ones. And over both those, you can put overlays, and you can decide to screen stocks out. That's something we've had for quite some time in terms of being able to knock out entire sectors or countries or themes in terms of investment. The other part, though, is we've recently added is the ability to start adding in exposures to particular areas, and that's one where in terms of Europe. Or if you're particularly interested in renewable energies or the battery stuff we spoke about from last week, it's a matter of sort of you can jump in and actually add that into your portfolio so that you can sort of get a little bit of extra exposure. So take an index exposure plus whatever, or take the nucleus view plus a little bit of extra of the factor you're looking for. And so, so I encourage people to have a look at that and give Sam a call and have a chat if there's particular themes you're trying to get a hold of, or things you're looking for a little bit more of, or things you're looking to avoid within your portfolios.
Excellent. Nice one, Damo. Thank you very much, Damo and Dave, for coming on the show again. And I'm sure the listeners got lots of value out of it today.
Thank you, Sam.
Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below, or send us an email at contact@nucleuswealth.com. Don't forget to like the video now. And if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content, or subscribe on our homepage for our weekly Nucleus news and investment insights. We do put out a lot of other articles and videos in addition to this podcast, so you can check them out there. And of course, you can follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.